So I chose Apple as my stock, and I valued Apple using a 5-year FCFF DCF model. I started with their 2025 fiscal year statements. I went and I projected 2026 to 2030 using the perpetual growth method for terminal value. My main question was, is this DCF value accurate to Apple's 300 and something dollar value? And if not, I wonder what are the differences, whack or whatever. Here are some of my key values, and here's how I calculated the FCFF. There's my formula using EBIT times 1 minus tax rate plus debt and assets minus capex minus delta NWC, net working capital. Here are my values that I got from their income statements. Here's my pro forma. Here's my pro forma projection based on those values and based on growth rates. Projected through 2030 using historical growth rates of 0.57 in the base case, 0.57%. I kept their margins and the financial statement ratios constant. These are assumptions, but not. These are some more sensitive assumptions: projected EBIT, taxes, depreciation, etc. There are limitations to that due to how many assumptions are being made. And my WACC, I base that off of these values here. The risk-free rate was based on treasury rates. The beta I was able to find on Yahoo Finance. Same with the risk premium. The RD, I used Apple's yield to maturity for that. Tax rate, that's what I found off their income statements. I used the capex to find the return on equity. Hey, one sec. Then after that, I used, that was everything I used to calculate the weighted average cost of capital. I used the market value, which was 8.91% compared to the book value, which was 6.08%. And then here are my 3 scenarios: the low, base, and high. Low scenario had a negative FCFF growth with a higher WACC of 9.91. Base had WACC of 8.91. Highest case scenario had a WACC of 7.91% with growth of 1.52 and 2.5% respectively. The low case assumes lower FCFF growth, a higher WACC, and a lower terminal growth. And the high case assumes higher growth, lower WACC, and higher terminal growth. And the base case is somewhere in between. The FCFF growth, constant WACC, and terminal growth are all very sensitive assumptions that may not reflect reality. And then here's my model. Here's the output for my model. Here is my assumptions ledger, the source, unit, value. So the present value of explicit FCFF is 378.9 billion. Present value of terminal value is 948 billion. The EV is 13.27 billion. These are projected values. The terminal value makes up most of the enterprise value, which is why the WACC and the terminal growth has such a large effect on the result. And I also used a reverse DCF to determine what growth the model would need to support at a 332.92 market price. Holding WACC at 8.91 and a terminal growth at 2%, Apple would need approximately 33.69 annual FCFF growth for the next 5 years. This is far more than I calculated at 0.57. This isn't proof that it's overvalued. It's just showing that there are high expectations for growth. And going back to my output, My base estimate is $92.68 per share with a range of 71 to 126. They're all well below the current price of 332. But this again does not prove that Apple is overvalued. It just proves that the expectations of the market cannot be accurately represented by the model, by my model at least. I would change my assumptions. I would assume higher growth, more than the 0.57 that I did, and I could also use a lower whack. And that was everything. Thank you.